Picture this. You wake up on a Tuesday morning in September 2008. You check your phone, and there's a text from your bank. Nothing unusual, right? Except this message says your money market account, the one you thought was as safe as a regular savings account, might not be there tomorrow. Within hours, investors pulled out $140 billion, not over weeks or months, in a single day. The Treasury Secretary got a phone call at 11 p.m. By the next morning, the federal government had committed $41 billion to stop what was becoming the fastest financial collapse in modern history. And here's the thing that should concern every one of us. Most people had no idea this was even happening. I'm going to walk you through exactly what broke, why it spiraled so fast, and what it revealed about where we actually keep our money. Because this wasn't about Wall Street billionaires losing their third yacht. This was about regular people's retirement savings, business payroll accounts, and college funds sitting in something they thought was completely safe. Let's start with what a money market fund actually is, because that's where this whole thing went wrong. Most people think of money market funds as basically savings accounts that pay slightly better interest. You can write checks from them. Your statement comes from Fidelity or Vanguard. They feel like banks. But here's the critical difference. They're not banks. And that difference nearly crashed the entire financial system. Banks are regulated one way. Investment funds are regulated another way. Banks have FDIC insurance that promise that even if the bank fails, the government backs your deposits up to $250,000. Money market funds, they have no such guarantee. They're investments. The industry had spent decades convincing people otherwise. For 37 years, money market funds operated on a simple promise: put in $1, get out $1, plus a little interest. They called this maintaining a stable net asset value, or NAV. In plain English, your account never goes down. It always shows exactly what you put in plus gains. This stability made them wildly popular. By 2008, Americans had parked $3.8 trillion in these funds. That's a trillion with a T. Retirees used them for monthly income. Small businesses kept their cash reserves there. It was the place you put money you couldn't afford to lose, but wanted to earn more than a regular savings account. The problem? That stability was an illusion. And on September 16, 2008, the illusion shattered. The fund was called the Reserve Primary Fund. Started in 1970, it was actually the very first money market fund ever created. It had a reputation: reliable, conservative, boring, in the best possible way. Then Lehman Brothers collapsed. Now, Lehman Brothers wasn't some small investment firm. It was the fourth largest investment bank in America, with $600 billion in assets. When it filed for bankruptcy on September 15, 2008, it sent shockwaves through every corner of the financial world. The Reserve Primary Fund held $785 million in Lehman Brothers debt, not stocks debt, commercial paper and short-term loans that were supposed to be rock solid. The kind of investments money market funds are supposed to hold because they're safe. When Lehman went under, that $785 million became worth pennies on the dollar. And here's where the math gets terrifying. The Reserve Primary Fund had $64.8 billion in total assets. Losing $785 million meant their share value dropped to 97 cents. 3 cents. That's all it took. For the first time in money market fund history, a major fund broke the buck. Industry speak for falling below that sacred $1 value. If you had $10,000 in this fund on Monday, you had $9,700 on Tuesday. Your supposedly stable, safe investment had just lost value overnight. The fund's managers made an announcement that Tuesday afternoon they were suspending redemptions. Translation: you can't have your money back. Not today, maybe not for weeks. Panic doesn't quite capture what happened next. Think about what a money market fund actually is. It's a pool of money from thousands or millions of investors, managed by a fund company, invested in short-term debt from governments, corporations, and banks. It works as long as everyone stays calm. But what happens when everyone wants their money at once? This is what they call a run. Not like a bank run you see in old movies, with people lined up outside buildings. This was digital. Point, click, transfer out. Except the money market fund doesn't actually have all that cash sitting in a vault. It's invested. To pay you back, they have to sell those investments. And when everyone's selling at the same time, prices collapse. By Wednesday, September 17th, investors had pulled $40 billion from the Reserve Primary Fund and other money market funds. By Thursday, another $100 billion was gone. The total, $140 billion in redemptions in less than 48 hours. Portfolio managers at other money market funds faced an impossible choice. They could sell their safest, most liquid assets to meet redemption demands, but that would leave them holding riskier investments, making their funds less stable. Or they could refuse redemptions, but that would trigger even more panic. Several funds that held Lehman debt started getting redemption requests running at 10%, 15%, 20% of their assets per day. For context, a normal day might see 0.1% movement. This was 100 times the usual volume. And here's what made this truly dangerous. Money market funds didn't just hold retirement savings. They were the backbone of corporate America's cash management. Companies used these funds to manage payroll, pay suppliers, and handle daily operations. When these funds froze up, businesses couldn't access the cash they needed to function. General Electric, one of America's largest companies, reportedly couldn't roll over its commercial paper. Translation, they couldn't do the routine borrowing that every major corporation depends on for day-to-day operations. The commercial paper market, worth $1.8 trillion, was seizing up. This is the market that lets companies borrow money for 30, 60, or 90 days to smooth out cash flow between when they pay expenses and when customers pay them. Without it, even profitable companies face a cash crunch. Treasury Secretary Henry Paulson was already dealing with the biggest financial crisis since the Great Depression. Major banks were failing, the stock market was in free fall, and now, on top of everything else, the money market system was collapsing in real time. On September 19, 2008, just 3 days after the Reserve Primary Fund broke the buck, Paulson announced an extraordinary intervention. The Treasury would temporarily guarantee money market funds. The program was straightforward but unprecedented. The Treasury would use the Exchange Stabilization Fund, a Depression-era emergency fund, to guarantee that investors in money market funds wouldn't lose money. If a fund broke the buck, the government would cover the losses. The price tag, $41 billion in backing. Later expanded to cover additional funds, the total guarantee would reach $3 trillion, nearly the entire money market fund industry. Think about that for a second. The government essentially said, we know these aren't banks, we know they're not FDIC insured, but the alternative, letting them collapse, is unthinkable. But the Treasury program only covered existing investments. It didn't solve the liquidity problem. Funds still needed cash to meet redemptions. So the Federal Reserve stepped in with its own program, the Asset-Backed Commercial Paper Money Market Mutual Fund Liquidity Facility. Try saying that 3 times fast. What it meant in practice, the Fed would lend money to banks, and banks would use that money to buy assets from money market funds, giving the funds cash to pay back investors. The Fed committed to lending up to $540 billion. Between the Treasury guarantee and the Fed lending facility, the government had erected a massive safety net under the entire money market industry. The panic began to ease. Redemptions slowed. By late October, money had started flowing back into the funds. The immediate crisis was over. But the implications were just beginning. Let's dig into why this happened in the first place, because the roots go deeper than just Lehman Brothers. Money market funds operated for decades on what's called the shadow banking system. They looked like banks, acted like banks, but weren't regulated like banks. This gave them advantages, lower costs, higher yields, but also vulnerabilities. The core issue was the stable NAV promise. To keep that $1 share price, money market funds invested in short-term, supposedly safe securities, government debt, high-grade corporate bonds, commercial paper from blue-chip companies. But supposedly safe and actually safe aren't the same thing. In the years leading up to 2008, with interest rates low, money market funds faced pressure to generate higher yields to attract investors. So they stretched. They bought debt from financial companies, the same institutions that were loading up on subprime mortgages and complex derivatives. The Reserve Primary Fund's $785 million in Lehman debt wasn't an accident or poor judgment. It was the result of systemic incentives pushing these safe funds into riskier territory. There's another problem: liquidity mismatch. Money market funds promised daily liquidity, you could get your money any time. But they invested in securities that sometimes took days or weeks to sell at full value. As long as only a small percentage of investors wanted out on any given day, this worked fine. But in a crisis, when everyone wanted out at once, the mismatch became catastrophic. This is the classic bank-run problem. Banks face the same issue. They lend out long-term, but promise depositors can withdraw any time. The difference is banks have FDIC insurance, access to Federal Reserve emergency lending, and strict regulations about capital reserves and risk management. Money market funds had none of that until they needed it. The government's intervention worked, but it came with a cost we're still calculating. The Treasury Guarantee Program officially ended in September 2009, exactly 1 year after it started. The government collected about $1.2 billion in fees from participating funds and didn't actually have to pay out any claims. On paper, the program made money. But that misses the larger point. The federal government had created what economists call moral hazard, essentially a guarantee that encourages risky behavior. If investors know the government will step in to protect money market funds, what incentive do fund managers have to avoid risk? Regulators knew they couldn't just return to business as usual. In 2010, the Securities and Exchange Commission implemented the first round of reforms. Funds had to hold more liquid assets, disclose their holdings more frequently, and undergo stress testing. But these changes didn't address the fundamental problem, the stable NAV. As long as money market funds promised to never lose value, they'd remain vulnerable to runs. In 2014, the SEC went further. They created 2 categories of money market funds. Government funds, which invest only in government securities, could keep the NAV stable. Prime funds, which invest in corporate debt, had to switch to a floating NAV, meaning your account value could fluctuate, like any other investment fund. Prime funds also got new rules about redemption gates and fees. If more than 30% of a fund's assets were redeemed in a week, the fund could impose a fee on withdrawals or temporarily suspend redemptions altogether. These reforms changed the industry dramatically. Trillions of dollars shifted from prime funds to government funds. Investors clearly preferred the stability guarantee, even if it meant lower returns. But here's the uncomfortable truth. We're not really sure the problem is solved. Fast forward to March 2020, COVID-19 hits. Financial markets panic. And guess what happened? Money market funds faced another crisis. In a 2-week period, investors pulled out more than $100 billion from prime money market funds. Sound familiar? The 2014 reforms were supposed to prevent this. The floating NAV was supposed to eliminate the incentive to run. But when markets panicked, investors ran anyway. Once again, the Federal Reserve had to step in with emergency lending programs. The scale was even larger this time, facilities that could support over $1 trillion in money market fund liquidity. This raises a serious question. Have we actually fixed the structural problems, or have we just created a system where the government is permanently backstopping money market funds? Some economists argue we should go further, convert money market funds into actual banks, with full FDIC insurance and banking regulations. Others say we should eliminate the stable NAV promise entirely, making it crystal clear these are investment products with risk. The industry pushes back, arguing that reforms have worked and the 2020 crisis was unprecedented. They have a point. A global pandemic isn't exactly a regular occurrence. But that's kind of the issue with financial stability. You're preparing for the unexpected. For ordinary Americans, especially those nearing or in retirement, This creates a dilemma. Money market funds remain popular because they offer easy access to cash with better yields than savings accounts. They're convenient for managing monthly expenses, emergency funds, or money you're about to invest elsewhere. But 2008 and 2020 proved they're not risk-free. That promise of stability can evaporate faster than anyone expects. So what should you take away from all this? First, understand what you actually own. If you have a money market fund, know whether it's a government fund or a prime fund. Government funds are genuinely low risk. They invest in Treasury securities backed by the full faith and credit of the U.S. government. Prime funds carry more risk because they invest in corporate debt. Check your statements. Most money market funds clearly identify which category they fall into. If you're not sure, call your broker or fund company and ask directly. Second, recognize that higher yields come with higher risks. If one money market fund is paying noticeably more than others, ask why. There's no free lunch in finance. Higher returns mean the fund is taking on more risk, investing in lower quality securities, or both. Third, think about FDIC insurance. Bank savings accounts and certificates of deposit are insured up to $250,000 per depositor per institution. Money market funds are not. For some people, especially those with significant cash holdings, this distinction matters enormously. You can spread money across multiple banks to maximize FDIC coverage. It's less convenient than one money market account, but it's genuinely safer. Fourth, consider your timeline and purpose. Money you absolutely cannot afford to lose, emergency funds, near-term expenses, money for essential bills, probably belongs in FDIC-insured accounts, even if the interest rate is lower. Money market funds make more sense for cash you're temporarily parking between investments or for funds you can tolerate some risk with. Fifth, pay attention to what's happening in the broader economy. Both the 2008 and 2020 money market crises happened during larger market panics. If you're watching financial stress build, banks struggling, major companies failing, stock markets plunging, that's when money market funds face the greatest pressure. This doesn't mean you should panic sell at the first sign of trouble. In fact, that's often what triggers the problem. But it does mean having a plan before a crisis hits. Know where your money is, know how to access it, and know what your alternatives are. The $41 billion emergency response to the money market crisis teaches us something profound about modern finance. The line between safe and risky is thinner than we think. For decades, the financial industry sold money market funds as cash equivalents. Marketing materials emphasized stability and safety. Account statements showed that unchanging $1 share price year after year. The message was clear. This is basically a bank account.
But it wasn't. And when the truth came out, it came out fast.
The government's decision to intervene wasn't really about protecting investors, though that was certainly part of it. It was about preventing a cascade that would have brought down the entire financial system. When businesses can't access cash for payroll, when municipalities can't roll over short-term debt, when the commercial paper market freezes, the consequences spread far beyond individual investment accounts. This is what systemic risk means. It's not just that one fund or one bank fails. It's that failure spreads like a virus through interconnected financial systems until everything seizes up. We've built a financial system that depends on confidence. Money market funds work when people believe they're safe. Banks work when depositors trust their money is secure. Markets work when participants believe they can buy and sell freely. But confidence is fragile. It can evaporate in hours, as September 2008 proved. The reforms since then have helped. Funds are more transparent, hold more liquid assets, and have better risk management. The separation between government and prime funds gives investors clearer choices. The possibility of redemption gates discourages runs. But the fundamental tension remains. We want the convenience and returns of investment products with the safety and stability of bank accounts. We want risk-free returns. And finance keeps trying to deliver this impossible combination right up until the moment it can't. The story of the money market fund crisis isn't just history. It's a warning and a lesson that remains relevant today. It shows us how quickly financial systems can break, how products we trust can carry hidden vulnerabilities, how even sophisticated investors and regulators can be blindsided by risks they didn't fully understand.
But it also shows us that solutions exist. Government intervention, while controversial and expensive, can work. Regulations can adapt. Markets can rebuild confidence. The system didn't collapse in 2008, and it didn't collapse in 2020 precisely because authorities stepped in decisively. For those of us managing our own finances, the takeaway is simple but important. Know what you own, understand the risks, and don't let convenience or slightly higher returns blind you to fundamental differences in safety. A money market fund is not a bank account. The $41 billion emergency response proved that in the starkest terms possible. The financial system has undoubtedly changed since 2008. Banks are better capitalized. Regulations are stronger. We have stress tests and recovery plans and all sorts of safeguards that didn't exist before. But human nature hasn't changed. The desire for safety and returns, the tendency to believe stability will last forever, the panic when it doesn't, these are constants. Understanding what happened in September 2008, why it happened, and what it means for your money today is one of the most valuable financial lessons any of us can learn. Because the next crisis will look different, emerge from different causes, and surprise us in different ways. But the fundamentals, the importance of true safety, the dangers of hidden risk, the value of understanding what you actually own, those lessons are timeless. If you found this deep dive helpful and want to stay informed about financial history, economic lessons, and stories that matter for your money, make sure to follow What Happened After. We break down complex financial events into clear, practical insights you can actually use. The $41 billion emergency response saved the money market system. Whether it solved the underlying problems remains an open question, and that's something every investor should keep in mind.